Hello students, welcome to my class. This is Professor Vincent Usaya and this is the presentation of part 2 of chapter 11, at current liabilities and payroll. We left off at this point at the end of part 1 presentation. So we are going to continue from objective 2, how to calculate and journalize basic payroll transactions. Now, of course, as you know, um, in the United States, we are all subject to pay tax on our income. It doesn't really matter how you make the income, and it doesn't matter from which source, we are obligated to pay tax. So we are going to talk about the payroll-related issues in this part of the chapter. So accounting for payrolls. Here are the key issues that we need to know. Employees are typically not paid as they work. In other words, we work every day, almost every day, but we don't get paid every day. We pay on payday. For some companies, weekly, bi-weekly, semi-monthly, so on and so forth. So we get paid periodically. Now, anytime employees have work but not yet paid, there is a liability that must be recorded. So by the time we work for a whole week and we have not gotten paid by our employer, our employer or the company that we work for is obligated to pay us, and the payroll has to be recorded. Now, like we said here, we said when employees are paid, they do not receive the gross pay that they have earned. And so what happens? Our company or our employer will withhold taxes and other deductions. Whatever is left is our take home. So moving along, let's take a look at a picture of how we account for payroll. Number one, we have the gross pay. Everybody is familiar with the gross pay. So that is the gross amount that you earn. But guess what? We have two different types of deductions. We have deductions that are mandatory. You really don't have no choice. You have to pay those deductions because the government forces us to pay those deductions. And number two, we have voluntary deductions. Those are the ones that you are not obligated or compelled to pay. For example, we call those voluntary deductions. You can actually instruct your payroll department and ask them to send $50 every month to Salvation Army. That is voluntary deductions. So let's take a look at the main deductions from our gross pay. Number one, we have OASDI taxes, and number two, we have Medicare taxes. Now, I want you to know that the OASDI stands for Old Age Survivor and Disability Insurance, and the second one is Medicare taxes. The OASDI and Medicare taxes, both of them are what we call Social Security tax. So Social Security tax is divided into two parts, OASDI and Medicare taxes. The OASDI taxes basically is the federal government imposed tax on us that the government will use that money to take care of us whenever we get old. And the Medicare tax portion deals with our medical expenses by the time we get to the Social Security age. So we also call this FICA, Social Security tax or FICA. Either way, both of them it is divided into two parts. Now, so this is federal government imposed. These two combined, Social Security tax. Then here's another federal government imposed tax. We call this federal income tax. That is the tax that you pay on your income. So like I said, it doesn't matter how you make an income or from which source you make an income, you are obligated to pay income tax in the United States. Then of course, we also have the state and local taxes. So the state government will also impose their income tax on you, meaning you have to pay tax on whatever income that you make. In some cities, we have also local income tax, like the city of New York. In addition to paying the federal, you pay the state, you also pay the city of New York income tax. Then, of course, you also have other voluntary taxes or deductions, like we said. So, by the time you back out all these deductions, whatever is left is called the net pay. Now, here's a question for you. If your employer agreed to pay you $5,000 every month for a total of $60,000 a year, the question is, do you really get paid? So we're talking about gross, we're talking about net pay. Do you really get paid $5,000 a month? A lot of students will respond, no, I don't get paid $5,000 a month, even though the employer promised to pay me $5,000 a month. That is the wrong answer. You do get paid $5,000 a month. You are not taking home $5,000 a month, not because you didn't get paid $5,000 a month. You are taking home less because somebody that is bigger than you and your employer said that some of the $5,000 should be withheld and the money should be sent to the government. Who is that? Washington, D.C., Barack Obama, and the Springfield. Okay, so the state and federal government. So all those taxes have to be withheld from you. So here is my point. At the end of the month, your employer is going to take credit for the $5,000. So your employer is going to say salary expense $5,000. He's actually going to write off $5,000 in that particular month. So that is very important for you to know. So let's take a look at how this works. So withholding for employee income tax. So these are the withholdings that the company will withhold from us. Look at this, federal income tax. How much tax do we pay on your federal income tax? It depends on whether you are married or single. It depends on how many dependents or how many children that you have. It depends on multiple factors. And it depends on how much money you make as well. But guess what? The people that, the maximum federal income tax rate is what? 39.6%. So yes, folks, there are people that pay 39.6% on their federal income tax. So if you make $100 million, and there are some people that make $100 million, they actually cough out pretty much $40 million of the $100 million in federal income tax alone. And of course, the state will also have 5%. The local, the city, for example, like the city of New York, will also tax that as well. So, like I said, how much federal income tax or state income tax that you pay depends on those variables. So moving along, let's take a look at withholding for employee social security and Medicare tax. So we did talk about this a minute ago. We said that social security tax, otherwise known as FICA, FICA stands for Federal Insurance Contribution Act, or Social Security tax. That is the federal government imposed tax on us. And when we get to the Social Security age, we get the benefit of that. So it's more or less like, not more or less, it's actually a federal government imposed retirement plan for all of us. Now, so it's divided into two. We have the OASDI and we have the Medicare taxes. For the year 2012 only, because for the most part, it is different from 4.2. The OASDI, which stands for Old Age Survivor Disability Insurance, is 4.2%. The Medicare tax is for 1.5%. So the 4.2% is applied to the first 110,000. That threshold is moved, or that post is moved every year. Now, for the 1.45%, you pay that on every income that you make. So if you make $100 million, if you make $1 million a year, you pay 1.45% on the whole $1 million. However, you pay 4.2% only on the first 110,000. Again, like I said, this 4.2% is only applicable to the year 2012. So, moving along, why is this important? Why is this important? Take a look at this. When the company withhold all these taxes, like I told you, the company agreed to pay you $5,000, but the company don't pay you. But the company pay you $5,000. You are taking less than $5,000 home because the company is obligated to withhold some. That sum that the company withheld from you is an obligation or debt to the company. So therefore, the company has to remit it to the government. Until they do that, it is part of their current liabilities or part of their current debt. So that would be a good cut-off point for part 2 of this chapter, and we are going to take we are going to do part 3 of this chapter presentation from optional withholding deduction.